Hi friends, today I am going to explain you about the concept and measurement of cost of capital. Cost of capital is an important area in the financial management, and what it will be referred is it is referred as the minimum rate or break even rate or target rate used for making different investments and different financing decisions. So, in the operation criteria, it is related to the firm's objective of wealth maximization. In other words, we can also say that cost of capital is the minimum required rate of return of the earnings expected by the investor from his investment. Means it is also known as a cutoff rate of the capital expenditure. What is the main significance of the cost of capital? It can be used for maximization of the value of the firm, and it can also used for the taking capital budgeting decision regarding leasing, and it can also be used for the management of the working capital, and it can also be useful for the taking dividend decisions, whether they wanted to pay the dividend or they wanted to keep the retained earnings in the firm. Right. Simply, in operational terms, it is defined as a weighted average cost of capital of all long term sources of finance. See, this is the weighted average cost of capital in sense. It is a overall cost of capital by using weights. How much the contribution of that particular long term source is involved in the total cost of capital. So here, the total cost of capital is also known as weighted average cost of capital. Here, the major long term sources of funds, or it could be debt, also known as debentures, or preference shares, equity capital, and retained earnings. See, all going together, it will be called as a total overall cost of capital. Right. Now, I am going for the how we can measure the specific costs. As I mentioned earlier, there are four types of specific cost. It could be cost of debt or cost of preference shares, cost of equity capital, and cost of retained earnings. Having said that, let me move on to the cost of long-term sources of finance one by one. In that, the first one is a cost of debt. The cost of debt, it could be after tax or before tax. Here, the cost of debt is nothing but how much interest, the rate of interest is payable by the company on the issued debt instruments, means debentures, is the cost of funds raised by it. However, moreover, it is the taxation is also playing important role in ascertaining the cost of debt or cost of debentures. As interest paid by the company on its debt instrument is all allowed as an expense under the relevant provisions of the Income Tax Act. If you are paying some expenditure, means it could be if you are issuing debentures, that will be tax exemption will also be available on the cost of debt. So we can use it as a cost of debt before tax and cost of debt after tax, right? But the effective cost of debt is less than the actual interest payment made by the firm by the amount of tax how it provides. So, the debentures or the debt can be either perpetual debt or redeemable debt. Perpetual debt is also known as a irredeemable debt. Perpetual in the sense it's a permanent in nature. So, what exactly the company issuing irredeemable debentures is nothing but has no responsibility as far as the payment is concerned, payment of the interest is concerned. So, what will happen? The repayment of the debt at the predetermined date and time should not be mentioned. It has the power to decide the time and dates to pay back the amount of debt as long as it is going concern concept. Because in the going concern concept, the company goes on forever. Means as far as the irredeemable debt is concerned, you don't have time to decide the dates and pay back the amount of debt as long as it is going concern. And therefore, the computing the cost of irredeemable debentures, only the same amount is taken into the consideration. Here, what could be the perpetual, what is the perpetual debt? See here, in case of perpetual debt, what is the formula we are going to use? Here, the is equal to interest by SV. KD is equal to interest of 1 minus T by SV. Here, KI in the sense before tax cost of debt. KD means tax adjusted after tax cost of debt. I, as usual, annual interest payment. SV sale proceeds. What is the face value? If it is any discount, if you issued at discount, it can be redeemed, I mean deduct it, and premium you can add it, and tax rate will be involved in that. Then I have given small example for better understanding purpose. A company has a 10% perpetual debt of 1 lakh. The tax rate will be the 35%. Determine the cost of capital before and after. If the debt can be issued at par or 10% discount, and 10% premium. See, in all the cases, the company has 10% perpetual debt of 1 lakh, means the interest is 10%, that is a 10,000, 10,000, 10,000. But here issued at par 1 lakh, issued at discount 10%, 90,000, issued at premium 1 lakh 90,000. And before the tax, this much, and after the tax, because 35% is a tax amount, this much. This is the way we need to calculate cost of debt before tax and after tax. Having said that, let me also make you understand about the redeemable debt. See, redeemable debt means what exactly the redeemable debt? Here, a redeemable debt or debenture, as the name itself suggests, that it can be redeemed by the company at predetermined date and time, or after prescribed period of notice is given in this regard. The average of the sale value of redeemable debentures is considered for calculation of the cost of redeemable debentures. Different formula we are using. See, I am giving the formula here. The I interest payment 1 minus T plus F is equal to flotation cost, means the issuing cost. How much cost you are incurring for issuing the debentures, means the cost could be the underwriting commission or any other preliminary expenses is involved. The issuing cost is known as the flotation cost over here. And D, discount on issue of debentures. PI, it is a premium on issue of debenture. P or premium redemption of debentures. At the time of redeem, how much premium you are making payment, that is also needed. So and NM, term of debt, RV, redeemable value of debentures, and SV, the total sale proceeds as mentioned earlier, face value of debt minus issuing expenses, all these things, right? So here, what is the that is the formula for that? What is the yield to maturity? You need to understand. Yield to maturity is nothing but how much return we are making payment to the debentures. The calculation of yield to maturity takes into account from the time of the purchase till the maturity. How much rate of return that measures the total return of the bond, how much we are paying from the time of the purchase until maturity. That is called yield to maturity. So, yield to maturity takes into account in the current market price, the par value, coupon interest rates, and the time of maturity. It is also assumed as a yield to maturity that all coupons are reinvested at the same rate. See, here IT by 1 plus y old T plus Pn by 1 plus y whole n. See here, see in the formula, we are P0 issue of the price of debt, the interest paid on debt, repayment of debt and maturity, yield written on maturity. And we can also, the shortcut formula is also there, 1I, 1 minus T. Here, tax rate, M, debt premium minus PB, that is the debt premium, how much it is, and N means the life of debt of number of years of to maturity, the M plus P by 2. It is also shortcut formula. You have to remember this, right? Then I have given one example for making you to understand better in proper way. So ABC Limited issues bonds par value 2,000 rupees at 12% interest rate on 8% discount for 10 years. Calculate yield to maturity. Here 12%, 240. See here 2000, see that is what we call 8% discount, in the sense 8 into 2000, it is a 160 we have to deduct from the 2000, that is a 1840. So obviously we are going to get 13.33% is a yield to maturity. Then this is what we call about the cost of debt. Now, having said all these things, now slightly I am moving on to the cost of preference shares. What exactly the preference cost of preference shares? Here, as we mentioned in the cost of debt, we need to make the payment, interest payment. But whereas coming to the preference shares, how much dividend payable on preference shares? It is not tax deductible from the point of view of the assessing tax liability, or it may be required to pay on the payment of preference dividend. On the contrary, what will happen at the time of assessing tax liability, the tax is not deductible, but at the time of in the hands of the investor, he has to make some interest payment in that. I mean, tax payment in that. Right. See here also irredeemable preference shares and redeemable preference shares. Irredeemable, it is a perpetual cost of preference shares capital. It is a irredeemable of the company. It generally, what is the dividend payable to its preference shareholders, we can calculate it in this way. So dp dividend by P01 minus F. Similar way, if it is a F means it is a flotation cost, means issued as issue or premium, issued cost how much it is, and the total net proceeds will also be considered here. And see, the tax amount will also be considered dt tax, and p0 expected sale price of the preference shares. See here, we need to calculate in such a way that the cost of preference shares in the case of irredeemable preferences is based on the dividends payable on them and the sale proceeds obtained by issuing such preferences, that is a p0 1 minus f, that is a sale proceeds. What is the sale proceeds? Face value plus premium minus discount minus cost of issue. That is the total things will be considered here. Right. That is a total things. Means if it is a flotation cost of issue, means that is the thing what we need to deduct from that. So that we are going to get the sale proceeds. Then I have given an example here. A company issues 10% redeemable preference shares of the face value of 100 rupees each. Flotation costs are estimated at 5% of the expected sales price, 1 minus 0.05 here. Right. What is the cost of preference shares if the preference shares are issued at par value, 10% premium, 5% discount? Also compute the cost of preferences in this assuming 13.125% dividend tax. Sometimes DDT, dividend tax, a distribution tax will also be applied. So we need to deduct from that after tax. So this is the way we need to calculate here. Issued at par, issued at premium, issued at discount before tax and after tax, like this. Right. Now, cost of redeemable preference shares. See, here redeemable preference shares are not perpetual, not continual in nature. They have the maturity date on which we need to, they are redeemed. They may be issued at discount or they may be issued at premium. So, cost of redeemable preference shares is calculated by this formula, that is dp plus m minus pb divided by n by m plus pb divided by 2. Here, m means par or maturity value of the preference shares or redemption value. PB, preference shares issue price, its purchase price or net realized value. M minus PB share premium. N means number of preference shares or number of years to maturity. So here the total life of the preference shares, that is, this is what we need to talk about cost of preferences. When we talk about the cost of equity capital, right? See what exactly the cost of equity capital. Similarly, what is the cost of equity capital? The cost of equity share capital, it can be minimum rate of return of a company is required to earn on the part of the equity financed to its investment in such a manner that the market value of stock remains unaffected. So what exactly here, the computation of is conceptually more difficult as written to the equity shareholders. It is solely depends on the discretion of the company management, whether they wanted to pay the dividend, whether they don't want to pay the dividend. That is totally discretion of the company's management. So here, what is the minimum rate of return that corporate must earn on the equity financial portion of investment? project in order to leave unchanged market price of the shares. These are the two approaches. There are different types of approaches are also there, but I have given two important approaches here: dividend valuation model approach and capital asset pricing model approach. Right. So here, what is the dividend valuation model approach here? First, I'm going for the dividend valuation model. As per the dividend approach, means cost of equity capital is defined as a discount rate that equates the present value of all expected future dividends per share with the net proceeds of the share. Here, the cost of equity capital can be measured in this way when the dividends are expected to grow at uniform rate. Every time we are increasing the dividend with uniform rate, then we can call it is a D1 by P0 plus G. Here, G means growth rate, P0 net proceeds per share means current market price of the share. So D1 means expected dividend per share. These are the cost of equity capital when dividends are expected to grow at uniform rate perpetually, means continually in nature, right? Under the different growth assumptions of dividends over the years, sometimes it could be less, sometimes it could be more. Then we need to use rate of growth in earlier years, sometimes the constant growth in later years. Then we are using this formula: d01 plus gb by t minus 1 by 1 plus k all to the power of t plus here sigma dn plus 1 plus gc. The growth rate might be different, all to the power of t minus 1 by 1 plus k all to the power of t. Here I have given one example. Suppose the dividend per share of the firm is expected to 1 per share next year and expected to grow 6% per year perpetually. What is the determine the cost of equity capital? That is the first formula we have used, the 1 by P0 plus G, 1 rupee by 25 plus 0.06, because 6% expected to grow per year, right, perpetually. But if it is a in another formula, the dividend approach can be used to determine the expected market value of share in different years. Expected value of a share of hypothetical, for example 6 at the end of the years 1 and 2 would be as follows in this way. This is the way we are going to 10% and 6% here. This is the way we are going to do that. One more example also I have given that uh, from the under the mentioned facts determine the cost of equity share capital. What the current market price is this, but the cost of flotation of share is 3 rupees. Dividend paid and outstanding shares over like this, means different years we are paying different ways. Dividend per share 10.50 differently. It's not in a uniform rate of growth of interest. Assume fixed dividend payout ratio, expected dividend on the new shares at the end of the. So this is the way we need to calculate here. As first step, we have to estimate the growth rate dividend using the compound interest rate. The annual growth rate of dividends would be approximately 5% cost. So during the 5 years, the dividend have increased from 10.50 to 13.40. Given compound factor of 1.276, we need to calculate that way. So in similar way, we have to do that. The calculation is that way. Let us understand the another approach of measurement of the cost of equity capital is a capital asset pricing model approach, that is also popularly known as a CAPM approach. What exactly it means? Means this model is totally based on the relationship between the required rate of return and risk-free security. Here, see, here RF plus B, KM minus RF. Here, RF is the required rate of return on risk-free investment. Here, risk-free interest rate is how much that we need to consider. And beta coefficient. Beta coefficient means the what exactly the beta, the degree of risk is involved in a particular security is known as a beta coefficient. The calculation of beta is entirely different, right? So here the cost of equity capital is non-diversible risk of the companies as indicated in the index. That non-diversible risk, non-diversifiable risk. Here this is the index, diversifiable risk, that is also known as a beta. Beta is we can't diversify, means diversification is not existent. Suppose it is a marketing risk and inflation risk, means we can't diversify with another way. So that is called non-diversible viability. But diversify risk is also known as, sometimes if it is a changes in the internally, that is a we can diversify with another cost of equity. But here we can't diversify it. That is known as the beta, right? So here, this is the way we need to calculate. The formula is RF, risk-free interest rate, plus beta Km, the required rate of the market folio, that is the average rate of return on all assets, and minus risk-free rate of return. So this is the way we need to calculate. I have given an example here. um, Here they have given the beta is 1.5 1.5, the firm's beta equals 1.5, the return of the market portfolio 12.5, and 10% is that is the 13.75% is the cost of equity capital. I have given one more example is expected return, and expected return is securities. We need to calculate in this way. What is the return, capital appreciation, total, the investment. Expected individual security. See, this is the different companies: 22.66, Steel Limited 20.80, Liquor Limited 17.16, and Government of India 26.15. Right. These are the capital asset. If it is a assume that the RF is 9%, RM is 18%. What is the security? Is a beta factor of it is a 1.44 here beta, and 1.0 and 2.3 you are going to get by substituting in the formula. Then the last one, what is the cost of retained earnings? Generally, basically, the cost of retained earnings is slightly less than the cost of equity because no issuance costs are incurred. What do you mean by retained earnings? In the sense, instead of paying dividends to the shareholders, they are going to keep the same amount within the organization itself. So for that, no need to incur any issuance cost. Why we are using for the cost of retained earnings? Cost of retained earnings, basically we are use it for the investment purpose. So company is not required to pay dividend out of retained earnings because it is the amount which set aside before taking decisions as far as the dividend distribution is concerned. However, to have a view that there is no cost involved in the retained earnings, perhaps it not be right. People think that there is no cost involved, no, but it is not right. Some form of return is expected by the shareholders from the retained earnings also. The cost of retained earnings may be the rate of return which is the existing shareholder would have got if retained earnings may be the rate of return if it is invested elsewhere appropriately. Means what people think that if they are distributing the dividend to us, the shareholders think in such a way that if I am going to invest elsewhere appropriately, invest in some other securities, how much rate of return we are going to get, that is called cost of retained earnings. So the cost of retained earnings is nothing but the opportunity cost of additional dividends the shareholders would have got if retained earnings had not been set aside and considered for the payment of dividends. See, in this way, we need to calculate it this way, that KE1 minus F. F is a flotation cost, KE cost of equity. Here, KRE is the cost of retained earnings. We are going to get it. So, how we need to calculate KE here? KRE divided by 1 minus F. We can come to this. This is the what we call cost of retained earnings. Again, I'm going to tell you cost of retained earnings is a what we call it is the nothing but it's basically it means that the opportunity cost of additional dividends the shareholders would have got if the retained earnings has not been set aside or and consider for the payment of this dividends. So that is the cost of retained earnings. See, the weighted average cost of capital means, as I mentioned earlier, it is a total overall cost of capital. Means it could be included cost of debt, cost of equity, cost of preferred shares, and cost of retained earnings. This is I have given one example here. This is the book value. The total is 50 lakhs, 25 lakhs, 5 lakhs, 7 lakh, 50,000. The cost is this much, and while we're going for the weights, how we need to calculate the total by this by into this by total into 100, that is a 52%, 31%, like this we are taking. The weighted cost will be like this. So the total weighted overall cost of capital will calculate in that way. Thank you for watching, thank you for staying with me, thank you for your support, and thank you for your encouragement. Thank you, one and